All right, so as yesterday's advance in the markets just a tease, it is certainly being unwound today and then some. A couple of catalysts for this. Overnight, of course, we got news that Asia is going from bad to worse and China is slipping. Its production certainly not what it was in the better part of 8 years. Also, it is now the slowest moving economy in Asia, something it has not seen since the early 1990s. Then there's the issue with Germany facing the highest interest rates and the highest inflation in the better part of 70 years. The Bank of England and the bouts that faded today, and add that up to the effect of higher prices on folks who are not buying as much at Rite Aid, hence the big disappointing earnings, and home buyers now backing out of deals at record high rates. Add it up and you got a lot of arrows going down. Mitch Roschelle with us, Macro Trends Advisors, LLC founding partner, Steve Moore, Donald Trump's former senior economic advisor. Mitch, to you first on what the markets are telling us. That was yesterday just a head fake? And, you know, because this buying on the dip thing, that's long gone, isn't it?
Well, there's still cash on the sidelines, and I think when there's anything positive for investors to jump in on, they do. But on a net basis, and I hate to be Debbie Downer here, on a net basis, I think there's a lot more headwinds than there are tailwinds. You ticked off a whole bunch of them at the top of the segment, but what scares me the most, and I think what's scaring the market, is a global mess. And if you look back at many of the recessions we've had, if not depressions that we've had, it often is a global problem. And when the market ran up, when we had synchronized global growth, by the same token, the market runs down when we have synchronized global failure, and that's what we have on multiple fronts.
You know, Steve, you think about it, the only game in down then is the Federal Reserve, right? I mean, Republicans and Democrats can't agree on anything right now. Republicans panning Democrats for all this spending. Democrats panning Republicans for saying the magical elixir is cutting taxes. And there we are. And now it's the Fed doing all the work, and some say overdoing that. Do you think the Fed is overdoing it, that with these rate hikes and no measurable effect on inflation yet, it risks torpedoing this economy?
Well, a couple observations. Number one, you know, there's a big story in the Wall Street Journal today about how the global fear about these massive government deficits, and I'm like, well, hello, that's been the case for, you know, we've seen that for 2 years. Why is it all of a sudden, you know, the investors are getting so fidgety about these massive deficits? They were baked in the cake. I mean, we spent in Washington $4 trillion just in the last 18 months.
We've had global debt levels that have been a huge concern for the better part of, what, 18, 20 years?
Well, yeah, and especially over the last, you know, since COVID hit. So right. I'm just saying, I have to say,
I'm puzzled. And they're not easing up on that. That's your point, right?
Right, exactly. Yeah. And I'm puzzled why all of a sudden we're seeing these massive sell-offs in the market. Now, I agree that the world growth is a huge problem. I mean, Europe is a mess. Japan is a mess. China is a mess. Where's the growth going to come from? You know, what country? Now, I actually happen to like what Liz Truss is doing in England. I think it's exactly the right thing, pro-growth policies. I hold out some hope for what's going on in Italy. Maybe some of these countries are turning to policies that can expand output. On the Fed, you know, the big question now is whether they will go forward with these continued rate increases. And I think the odds have dropped considerably over the last 24 hours.
You know, Mitch, looking at how the British market responded to these moves by Liz Truss, the tax cuts and the offshore oil production, what was alarming to me, and I actually did a little research here, it's very similar to the initial reaction Maggie Thatcher's tax cuts had, and very similar to what Ronald Reagan's tax cut proposals got. Now, of course, that was in the just coming into office and everything we were dealing with the inflation, everything else. But I remember the Wall Street Journal famously saying, essentially, you're overdoing it, Mr. President. So they were not received initially favorably. And they worked out, I think it's fair to say, in retrospect. But what do you make of that, whether the markets might be giving a false signal here, not only abroad, but here?
Well, you know, if you look at the situation in the UK, what's really, really alarming is the central bank and so monetary policy and fiscal policy with the new prime minister aren't synced up at all. Because the central bank is trying to keep that economy afloat and keep their bond market afloat, worried about pension funds, you know, sort of being upside down. So what are they doing? they're printing money. They're buying basically their treasuries. They're buying their bonds, and they're doing it at a big clip. So they're printing money, which is inflationary, while from a fiscal policy perspective, the prime minister is trying to do something to stimulate the supply side. I think those cross currents could be very troublesome if they don't get their act together and harmonize whatever their strategy is.
Well, by the way, that's exactly what we're doing here in the United States. You've got, the Congress. They just passed a new budget just 48 hours ago in the Senate, Neil, that has more spending in it. They're not cutting spending, they're increasing it. Meanwhile, the Fed is trying to slam the brakes on the economy. So I agree with that analysis. It's happening all over the world. Reckless fiscal policies and then trying to have the central banks deal with the wreckage.
And that's a very good point. And Mitch, if you think about it, let's say you had the $5 or $6 trillion of added spending, right? No less than Jamie Dimon at J.P. Morgan Chase had said it creates the mess we're in and compounds it for the Federal Reserve, right? Because it's unloading that balance sheet, trying to get rid of all these Treasury notes and bonds and mortgage-backed securities and municipal securities. It's been scarfing up, and yet just as it's doing so, there's Congress, adding another $5-6 trillion on, so that it's going out and it's coming in. No wonder why rates aren't budging.
Well, by the way, let's leave the stupidity of Congress with fiscal policy aside for a second. Just the budget in place, just the programs that are in place are requiring the Fed to basically continue to print about $1 trillion a year. So you're right. And what's happening, it's interesting. When Steve was in the Trump administration, they had a great idea. Steve Mnuchin had this great idea to basically refinance all that debt with a 40 or 50-year bond, right? So what are they doing? When the Fed went and printed money, they did a lot of it on a short-term basis. So there are literally 26 basis points, a quarter of a percentage point Treasury securities that are being refinanced at 400 basis points, at 4%. And that's really the soup that they're in right now.
Yeah, for every tick up, we've added, about $220 billion to our debt with this uptick in rates, what it's been. But go ahead, Steve.
Neil, you mentioned the S word just before we came on, the stagflation word, which is what we all dread. But I hate to see it. I think that's exactly where we're headed right now, with very, very slow and maybe negative growth continuing, and this kind of persistent inflation of 5, 6, 7, 8, 9%. And it's an ugly picture out there right now. What I want to see most out of Washington right now is a firm commitment to start cutting government spending. And frankly, I'm not hearing that from either party right now.
No, you need to wake up, young man. But anyway, hope springs eternal. Right. Gentlemen, thank you very, very much.